Before we get started, if you want to see more videos like this, hit that subscribe button and like this video. All right, so get this. We're diving into how to buy an apartment building with zero money down.
No money down. That's got to be some kind of real estate myth, right?
Yeah, it sounds too good to be true, but it's not a myth. It's called equity sharing, and we've got some legal experts to break it down for us.
So basically, it's like teaming up with an investor who helps with the down payment.
Exactly. And as the occupier, you'd handle managing the property and the day-to-day expenses.
Makes sense, especially if you're eyeing a property that's a bit pricier.
Right, like that $2 million apartment building you're thinking about.
Oh, yeah, that one with the hefty existing loan.
Yeah, that $1.9 million loan isn't exactly pocket change, but with equity sharing, you might actually be able to swing it with very little cash up front.
Okay, I'm intrigued, but no money down. There's got to be a catch, right?
Well, the catch is it's not about just skipping the down payment altogether. It's more like forming a structured partnership with an investor.
And in this case, the investor could actually be the seller themselves.
Wait, hold on. The seller can be the investor. How does that work?
Well, think about it. The seller's already invested in the property, right? So instead of asking for a huge down payment, they might be open to becoming your equity partner and financing a part of the purchase themselves.
So instead of giving them a big chunk of cash right away, you're basically offering them a share of the property's future appreciation.
Right. It's a win-win. The seller gets to keep a stake in the property, and you get to become an owner without that massive upfront cost.
So how does this partnership actually get set up? Do we just shake hands and hope for the best?
Not quite. There's a legally binding document called an equity share agreement, and this is super important because it spells out everything.
Okay, so everything's out in the open?
Yep, the ownership structure, how the appreciation is split, who does what, and even the exit strategy, it's all in there.
So this isn't just some casual agreement. It's a serious legal document that protects both sides.
Exactly. And it brings us back to that $2 million apartment building you
It's
mentioned.
one I'm obsessed with.
That's the one you and the seller, who would be the investor in this case, could decide to hold the title as tenants in common.
Tenants in common, what does that mean?
It basically means you both own a specific percentage of the property. Maybe you agree on a 70-30 split in your favor since you'd be managing the property.
So I'd own 70%, the seller investor would own 30%, and we'd both benefit from any increase in the property's value based on those percentages.
It's like slicing up the ownership pie, and tenancy in common also gives both of you the flexibility to sell your shares independently later on if you want to.
Gotcha. But let's go back to the no money down part. Does the seller just waive that remaining $100,000 goodbye?
Not exactly. They're essentially financing it for you. They're taking the risk that the property will go up in value enough to make their investment worth it.
Okay, so instead of a huge upfront payment, I'd be making smaller, more manageable payments to the seller over time.
Exactly like a built-in financing plan, but instead of a bank, it's the seller who's acting as the lender.
That's actually pretty clever, and I'm guessing this is where that equity share agreement comes in again.
You got it. The agreement also outlines a clear exit strategy.
Right.
What happens if either you or the seller wants out of the partnership?
That makes sense. You wouldn't want to be tied to this forever
Yeah.
if things change down the road. So what are some typical exit strategies?
Well, one option is a buyout where you buy the seller's share of the property based on how much it's worth at that time.
So if the property value skyrockets in those first few years, I could buy out the seller's 30% at a profit for them, and I'd become the sole owner.
Exactly. A win-win for both of you. And on the other hand, the seller could also decide to buy you out, which would give you a lump sum payment for your 70% share.
That's right. It gives them a way to cash out, and you get a potential profit without having to sell the whole property.
So it's like having these built-in options for the future, which is pretty reassuring. But what happens if neither of us wants to buy the other out?
Well, that's where the third common exit strategy comes in selling the property and splitting the money based on your ownership percentages. Gotcha. So we'd sell the apartment building, pay off any remaining debt, and split the profit 70% for me, 30% for the seller investor based on our example.
Right, a clean, simple way to wrap things up.
It is, but how do you actually decide on the price? Whether it's for a buyout or a sale, do you just like throw a dart at a board?
Not quite. The equity share agreement usually has a clause that says the price will be based on the fair market value of the property at the time.
Okay, so you get an appraisal to figure out what the property is actually worth in the current market.
Exactly like having a neutral third party come in and say, hey, this is what this place is worth right now, making sure things are fair for both sides.
That takes away a lot of the guesswork. I like it, but let's get back to those regular payments you mentioned. How do they actually work? Is it like paying rent to the seller investor?
You're on the right track. The seller investor has to charge you fair market rent for using their portion of the property.
So even though they're an equity partner, they still act as a landlord in a way. How do you determine what fair market rent is, though?
It's all about looking at similar properties in the area. What are comparable apartments renting for? What are the typical rates in the neighborhood? Things like size, amenities, and location all matter.
So it's not just a random number. You're using real data to figure out a fair rent that reflects what the seller investor is bringing to the table. But where does that rent money go? Does the seller just pocket it?
Not necessarily. Remember, they're still responsible for a portion of the mortgage and other expenses, so the rent you pay usually goes towards covering their share of those costs.
It's like a closed loop. The rent I pay helps cover the seller investor's expenses, keeping the partnership balanced. And here's where things get even more interesting, the tax benefits.
Ah, yes, the sweet sound of potential tax savings. This is where equity sharing can really shine for both parties.
So it's not just about the ownership and potential profit, there are tax advantages too.
Absolutely. Let's start with you. The occupier, you get to deduct mortgage interest and property taxes, just like a traditional homeowner.
So I'm getting the same tax breaks as someone who put down a massive down payment. That's a huge. Plus, what about the seller investor? Do they get any tax perks?
For sure. They're basically treated like any other landlord when it comes to taxes. They can deduct things like mortgage interest, property taxes, insurance, and even depreciation.
Wait, depreciation, what's that?
It's a way for the seller investor to deduct a portion of the property's value each year to account for wear and tear. It helps lower their taxable income, which can lead to significant savings.
So they benefit from the property going up in value and they get some nice tax breaks along the way. It's a financial win-win for both sides.
Exactly. Equity sharing offers this unique combination of financial and tax advantages that you wouldn't find in a typical real estate deal.
I'm starting to see why this is becoming so popular, especially with today's market. It's like finding a creative way around those huge down payments and rising property prices.
You got it. And it's perfect for situations like yours where you found an amazing property but need a flexible and affordable way to make it happen.
But let's be real, not every seller is going to be thrilled about becoming an equity partner. How do you even approach this conversation? Any tips for finding a seller who might be open to this kind of arrangement?
It all comes down to finding a seller who is motivated and gets the potential benefits of this partnership.
So someone's just thinking outside the box, not just focus on that immediate big down payment.
Yeah.
But where do you find these open-minded sellers?
Well, you might have to look beyond the usual listings, properties that have been on the market for a while, or sellers who are in unique situations might be more open to creative solutions like equity sharing.
It's about finding those hidden gems, the sellers who are willing to explore a different path. But how do you actually pitch this idea of equity sharing without scaring them away?
It's all about framing it as a win-win solution. Highlight the benefits for them. They still have a hand in the property. They get consistent income from the fair market rent you'll be paying, and there are those attractive tax deductions.
So instead of a one-time transaction, it's a long-term partnership where everyone can come out ahead. It's a compelling proposition for the right seller.
Exactly. And remember, honesty is key. Be upfront about the equity share agreement, the ownership percentages, the exit strategy, and all the financial nitty-gritty.
Open communication and building trust are crucial in any partnership, especially when it involves real estate and a lot of money. But let's face it, not every seller is going to be on board with this. What are some red flags to watch out for? When should you walk away from a potential equity sharing deal?
That's a great question. You don't want to get into a bad deal. One big red flag is a seller who isn't willing to put everything in writing with a solid equity share agreement.
So if they're hesitant about the legal side of things or trying to cut corners, that's a sign to be careful.
Absolutely. Another red flag is a seller who doesn't seem to grasp the whole concept of equity sharing or pushes for an ownership split that's heavily in their favor.
You want a partner who's genuinely interested in working together, not someone who's trying to take advantage of the situation.
Exactly. You don't have to settle. There are plenty of sellers out there, and finding the right one is crucial for a successful equity sharing experience.
It's about doing your research, trusting your gut, and being ready to walk away if things don't feel right.
Yeah.
But let's say you found the perfect property and a seller who's open to this whole equity sharing thing. What's next? How do you actually structure this agreement to make sure the partnership runs smoothly? This is where having a really good real estate attorney can be a lifesaver.
Totally. They can help you put together a rock-solid equity share agreement that covers all the bases and protects both sides.
Makes sense. So we've got the legal part figured out, but let's talk numbers. We're dealing with a $2 million apartment building, and you mentioned making regular payments to the seller investor. How do we figure out a payment plan that's fair and manageable?
Time to put on your financial analyst hat first. You got to look at the property's income potential. How much rent can you realistically collect each month?
Right? You need enough to cover your share of the mortgage, property taxes, insurance, all those fun expenses, plus the payments to the seller investor.
Exactly. It's like running a small business. Got to make sure the income can handle the costs and those payments to the seller investor.
So how do you structure those payments? Is it like a set amount every month?
There are a couple of options. You could go with a fixed monthly payment, kind of like a traditional mortgage, or you could do something more flexible where the payments are tied to how well the property's doing.
Interesting. So like if the property is bringing in more money, the seller investor gets a bigger share. But if things slow down, I'm not stuck with a huge payment I can't afford.
It's all about finding a solution that works for both of you and aligns with your partnership goals. And this is where that open communication with your seller investor is super important.
Working together to create a payment plan that benefits everyone.
Exactly. And as you're putting this deal together, don't forget to think long-term, what are your plans for this property?
Do I want to buy out the seller investor eventually and own it all myself? Or maybe hold on to it for a few years and then sell it together to make a profit?
Having a clear vision for the future will help you make those decisions about payments ownership and the exit strategy. It's all about setting yourself up for success from day one.
Love that. And speaking of setting yourself up for success, another crucial piece of the puzzle is building your business credit.
Couldn't agree more. Having solid business credit can open so many doors when it comes to financing options and getting better terms down the road, whether you're buying an apartment building, flipping houses, or anything else in real estate.
It's like having a secret weapon in your real estate toolkit.
Right. A good business credit score can give you a real advantage and help you land those dream deals.
So where can our listeners go to learn more about building business credit and getting those perks?
If you're ready to take your finances to the next level, head over to fixflipcredit.com. They have the best business credit mastery program out there. It's seriously a game changer.
It's all about having the knowledge and tools to navigate the world of real estate financing, and fixflipcredit.com can help you do just that. So what's the bottom line for our listeners? Equity sharing can be a powerful way to buy real estate, especially if you're facing a scary down payment. It's about teamwork, sharing the risks and rewards, and reaching your home ownership goals together.
And remember, it's not just about the property. It's about finding the right partner, someone who's on the same page as you and ready to take on this journey with you. Do your research, ask the tough questions, and don't be afraid to walk away if things don't feel right.
Could have said it better myself. It's all about empowering yourself with knowledge, building strong relationships, and taking a collaborative approach to real estate investing. Who knows? Maybe you could even become the investor in an equity sharing deal. Think about the potential returns and how you could help someone else make their home ownership dream a reality.
It's about thinking differently, finding creative solutions, and making sure everyone wins.
If you found this information helpful, hit that subscribe button and like this video.